Corporate finance practice problem using OneNote. Internal rate of return, the IRR or problem 2. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote and would like to follow along, you're not required to, but if would like to, we're on the icon left-hand side, practice problems, then 1222 internal rate of return or IRR problem 2 tab. Also note, when using OneNote, look at the Immersive Reader tool. Our presentations up top will be mirrored in the text area down below. Same name, same number. Transcripts down below. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the tab up top, we're going to be going through our calculations or information up top, calculating them on down below. Similar kind of scenario we've seen in prior presentations in that we have a situation where we have an initial investment and we expect to have that down payment up front and have a return in the future, possibly multiple years into the future. Therefore, time value of money being important oftentimes in that decision-making process. That initial investment or the investment we're putting into might be equipment we're purchasing, might be an investment we're purchasing, could be a project that we're putting money into, any kind of thing where we're putting money down and we're expecting to get a return on it at some point in the future. We're focusing now on the internal rate of return. The internal rate of return is one of two major calculations that do take into consideration the time value of money. So when you're looking at these long-term projects, you want to take those that have the time value of money included in them. The other being the net present value, the NPV calculation. The two calculations are related to, so you want to keep them in mind and the relationship between them in mind as we will do going forward. So we're going to say the initial investment we're putting down, in this case it's going to be equipment, we're going to say $60,000. Cash flows per year, we're going to say there's an even cash flow per year, $12,000 for 6 years that we're going to be getting into the future. The cost of capital is the 11%. Note that this 11%, you might hear it called different things. It could be the discount rate, it could be the required rate of return, cost of capital, the hurdle rate, sometimes called. That's going to be the rate that we might originally think of it as calculating the rate that we would need to hit in order to accept the project. So when we do the present value calculation, which we will do first, and then figure out the internal rate of return, remember that we're not trying to look at the cost of the money or the present value as if we're just taking the value of the dollar. In other words, the purchasing power or inflation of the dollar. This 11% includes in it the profit typically that we expect to be receiving. Therefore, anything that we get this present value calculation, the net present value over zero, would mean that we're getting the required rate of return or clearing the hurdle rate and therefore would accept the project possibly. Now, if we then get a positive number on the net present value calculation, we might then ask, well, what if I have multiple projects and I want to compare them to multiple other projects? What if I want to know what the rate of return is on a percentage basis? Then we can go, that's when we go to the internal rate of return, right? The internal rate of return will tell us what the percent would be. What would this percent be to get this series of payments to be zero? That's going to be the internal rate of return calculation. Mathematically, the internal rate of return kind of confusing, but with Excel, quite easy to do. So it's easy to kind of do in practice. What you want to have in concept is a good idea of the relationship between the two, what is actually going on. So we will start off with the present value calculation and then figure the internal rate of return two ways, one using trial and error and the other being the internal rate of return calculation within Excel. So present value, if we did our present value calculation, we could start with this information up top and just basically list out our payment structure. So let's look at it this way first. We would then say, well, we have payment 0 or time period 0, where we put down that $60,000, negative $60,000. Then time periods 1 through 6, where we have an even $12,000. Now, we happen to have even payments here. We'll have some examples later that will have uneven payments. You might think that you might want to use an annuity kind of calculation in here in part of your calculations. You could. You don't need to. If you're using Excel and you have the present value calculation, often it's simply easier to just list it out whether they be even payments or not, and then use Excel to basically calculate the present value of 1 after each year that we go out here. So that's what I would typically do. That's the general practice. But as we saw before in the present value calculations, there are multiple ways that you can kind of put together your present value calculations. If we present value these using this 11% rate, which includes typically our expected required rate of return in order to accept the project, the first one's 60,000 because it's at time 0. The 12,000 being present valued back 1 year would be the 10,811. The 12,000 2 years present valued back would be the 9,739. Now, I'm not showing the present value calculations here. We're imagining we could do it basically in Excel. We could do it with mathematical formulas or with the tables as well, as we saw in present value calculations in the past. So you can go to those calculations if you want to look into more of the calculation side of things, or if you want to go to Excel, we'll go through the actual working through them in Excel as well. So then the year 3, we got the 12,000 present valued back at the discount rate of 11% is 8,774. Year 4 would be the 7,905. Year 5, the 7,121. And you can see here clearly that as we go out into the future and have the same amount of payments that we expect to be receiving, the present value as discounted using the current 11% rate makes it go down each period, right? If we then sum up the sum of payments, the 60,000 outflow minus the inflows, we have a negative number, which means that we didn't clear the hurdle rate. So if this was 0, for example, then even if it was 0 or just $1, then that doesn't mean that we're just earning $1 on the project. That would mean that we cleared the 11% rate of return, which typically includes the required rate of return. So even if it was $1, we might say, yeah, that'd be a project that might be good because it has a rate of return included in it for basically our hurdle rate here. If it's anything under 0, then it didn't clear our rate. And so this one didn't clear the 11%. And so typically would be rejected. Now over here, if we didn't present value it, we would have earned 12,000. So you could see how the thought process would go. We'd say, hey, if I did this, we can make $12,000 not taking into consideration time value of money. But if I want to take into consideration time value of money, which I should since it's 5 years out, I would want to come up with some type of rate that would include the internal rate of return and see if we calculate this to be, if it was greater than 0, we might accept it. Now, we might also want to say, well, what is the actual rate of return? We can see that it's not 11%. It's lower than 11%. But what is it? If I want to compare it to other projects, that would be the internal rate of return. What rate would this need to be in order to get that to 0? So we could do that with trial and error. I can redo this calculation multiple times, keep on lowering this rate until I get to the rate where that would be 0. So conceptually, you can kind of see how that would take place. You could do that with Excel quite easily if you used formulas to map these out, which we have done in a practice problem. You could check that out. If you do that, you can say, hey, Excel, I would like you to basically lower this amount, the rate here, to whatever rate would make this series of flow payments 0. That would be the internal rate of return. And you could tell Excel to do that, and it would then come up with 5.47 about. This is rounded percent. And then if you did your same present value calculation using 5.47, you should then come with the end result being 0. So that means that's going to be your internal rate of return. This 5.47 then can be compared with other projects that might have a similar, flow, and you can then see the higher the rate, the better for the internal rate of return. Now you can also do this kind of series of payments with the internal rate of return formula in Excel. Once again, it's kind of difficult to do mathematically. You could do it with trial and error mathematically, but it becomes somewhat difficult to do. So it's not really nice for even test questions. Oftentimes don't force you to do it, but you can ask conceptually what it would be. In practice, of course, it's very useful calculation and quite easy to do with something like Excel. Now you could take the same series of payments. You'd have to map out the payment. So if you were given the data like this, where you're just saying, I have 12,000 for the next 6 years, you still need to map out the data. If it was in Excel, negative numbers being outflows, positive numbers inflows, so that you have your list of data down here. The last total happens to be 12,000, but we're only looking from period 0 to 6. And then the formula is quite easy once you map out the data, which would just be equal to the IRR brackets, and then you use the range and that would be from the 60 down to the 12,000 here, just like the sum function in that case, except it's the IRR or the IRR function, and then you'd sum it up, and that would give you your value of the 5.47. Note, if you use this function, it's quite easy to do. It's very nice, quick way to get it. Then you'd probably want to check your number by then basically using this to calculate, as we did up here, the net present value to double check that the net present value using the internal rate of return gets to 0. There's also a function for the net present value you can use as well, and we'll talk about that in a future presentation, but it's almost just as easy to do the present value calculations this way if you're already using Excel, because you can autofill that down. So we'll talk about that more in the future, but in any case, you want to go back and forth and double check these, because that'll give you a better understanding of what the relationship is between the internal rate of return and the net present value calculation.